Hello, Peter. Can you unmute, please?
There we are. I was speaking and nobody could hear.
Yeah, you were muted. How are you?
I'm good.
You have a note from your mom?
I do.
Okay. The dog ate your homework?
The dog ate my homework, and
all right. All right. So I'm glad you're here, and I talked to you a few weeks ago. Has anything shifted with new highs in the
no,
S&Ps?
actually, that's what we're gonna go over here, and I'm gonna share my screen here. Let's see, where is it?
Finally getting a little bit of a reversal here today.
Yeah.
Okay. There you go.
So basically, this is what we discussed a few weeks ago.
What's on that Barron's cover, Peter?
That is the unstoppable tech.
Okay.
The unstoppable tech cover.
I see. Okay. So it's kind of like that triple Q commercial you see on TV. Oh, I own the QQQ. So
yeah, exactly.
Okay. All right, but a Barron's cover is classic. When did that come out? When did that come out?
It was last week.
Oh, perfect timing, Barron's.
So basically, we're hitting this very, very long-term channel on the S&P. We have major divergence. I'm, setting up trades around this area. Obviously, I wanted to sort of.
You kind of had a box, didn't you, where it said, I think I remember, it may have been a tweet or it may have been what you had sent me on Twitter, where, be short with us in a box.
Yeah.
You had an area. Okay.
Yeah. Basically, I've been building short positions here and trading around those, with longs as well. But what we see, interestingly, is that there has been a consistent pattern between Bitcoin making a lower high and markets making higher highs. And I think that that's something that appears to be looking to play out. You guys were just talking about the dollar. And even though the dollar, has consolidated a little bit since here, it still looks very productive to me. I think it seems like you would say that there's a lot of credit available, but there's actually not enough cash available, which is what I see. And, again, what I'm seeing here is also, a lot of divergences in commodities here. Oil versus S&P is a pretty big disconnect. The economic surprise index is also, really, really, I think the biggest divergence I've ever seen versus the market. Consumer confidence is also looking to me like it wants to go, quite a bit lower, which when you look at where the markets are is suggesting a very big problem for markets. So I continue to have a pretty, negative view of what this market is capable of. Additionally to that, we aren't really getting big buyers, emotional buyers. We're getting a lot of, very tame kind of selling into bounces. That's what I'm seeing broadly, and the tick index helps you see that. Here is this cover again, and the Citadel basically closing a lot of its big positions. And here's Microsoft, compared to Sun Microsystems in 2000, which I think is an interesting discussion because, pretty much, I don't see that there's a really big difference here, except that Microsoft fits into the narrative of the working at home technology related stuff for.
There wasn't cloud computing back then, was there?
Yeah. And, I think that, we're very much looking at a situation in which I think that the dynamics that are pumping Microsoft and pumping a lot of these other big FANG names are going to run into very similar reactions as to what happened in 2000. This is an interesting chart as well, just looking at the NASDAQ breadth is just horrendous. And people keep saying that breadth doesn't matter. My experience is exactly opposite. You should not be ignoring the idea that breadth and participation in this market is so bad. It's really horrendous. And it's not a sign that everything's okay. It's a sign that things are not okay. The other thing is the idea that people think repo is actually helping here. I don't know if you saw recently, hedge funds have been using the repo window to try to sort of show collateral so that they could cover margin calls that they had with this repo collateral, and that was canceled. It's part of the reason I think the market has been doing some of the weirdness that it's been doing the last week or so. But basically, repo is almost always not stimulative in the end. It basically creates marginalized assets that cannot be used for fractional reserve, where reserve assets that are on a bank balance sheet can be used for fractional reserve and then are stimulative. And so almost always when you have increasing repo activity, you're going to end up with decreasing credit activity. And I think that this is something that we're going to be seeing. It's one of the reasons that you see the dollar being relatively strong now relative to what people might think. People would think, okay, well, the dollar should be weak, the dollar should be zero. But the repo activity has been holding up the dollar because it's exactly not it's not credit stimulative. It's the opposite.
Did Paul address that at all?
No.
Jackson Hole?
Okay. Yeah, this is a good article, something that, I would recommend reading, and it shows that spike in repo loans is an early warning for market disconnects. This margin debt has contracted further, and it's very negative. Additionally, on this, you can see the Chinese credit impulse moved basically 6 to 7 months forward. And you can see this is also a drag on the market, and it's going to, drag credit creation lower. And basically, the bubble we're in needs credit creation on a mammoth scale.
I heard this, Peter, and when I heard it, I was glad we were going to talk today. I'm hearing there's a pretty good chance because of what happened in Afghanistan and people becoming already disillusioned with the Biden administration, that he may not be able to get either infrastructure bill passed, and that the Fed is going to compensate with another $3 trillion of QE. What do you think of that?
I don't think the Fed is going to do $3 trillion of QE. I think the Fed is in a very difficult spot. I think that they're going to try to be doing as little as possible, and I think the Fed, needs to unwind this bubble. Again, I want to also show that on this chart we have a beautiful.
I've been showing, showing RSI divergence.
And it's a channeling, so this should be, a major inflection point. Here are more,
It's today, Peter. You're on. Today's will mark the high, maybe, huh?
Yeah. And basically, these breadth disconnects here have consistently been important, whether people believe them or not. The fact is that we have essentially 5 stocks, 6 stocks, 7 stocks driving the entire market. Yeah. And I have never in my lifetime seen anything as wacky.
Narrow? Narrow? Have you ever seen a narrow?
Yeah, I've never seen anything as narrow, and I've never seen anything as, as perverse, because basically what we're getting from 2 or 3 stocks, or 4 or 5 stocks, however they tend to be, is just enough to keep the market floating, while underneath the surface we're having stocks down 20-25%, in a lot of cases. So we have this VIX is still looking to be putting in a lower basically a higher low. This is inverted, right? To me, so these are very broad patterns. Here I'm looking at.
What's the range on your box?
What?
The box to your shorting box that you had on the chart before. What's the range for being short in that box? You want to share that?
The 43s to 44s. I'm continuing massaging my short position. So, like, for example, we'll get long when there's a good time to get along, and that raises my cost average. But my goal is to be short for what I think is going to be a 40+ point decline in the market, 40+% decline.
Okay. All right.
I think it's going to be much bigger than people think. And I think it's going to be more persistent. And I'm not sure if we're going to come back. And normally I'd be looking for this. I'd be looking to come up, make this top, drop 25-30%, and then go make a new high. But the activity here has been so manic that I'm not sure that's going to be possible. Here is my parabolic top tool on the Dow, which triggered basically in June with the Dow around 35,000 or so. Now we're 35,400. The Dow really hasn't gone very far. The S&P and the NASDAQ have behaved like they're in different planets. Something I was not thinking would happen as much as that. But it is what it is. And I think, we're really looking at the markets coming back down and testing below, 3,200, 2,700 here. And here's our, consumer sentiment, looking to me like it wants to see, a much bigger drop down, which would then drag the S&P. I have some weird graphics here.
Let me ask you this, Peter. Is it going to be the kind of when we start declining, could it be more drawn out than it was in 2020 with the COVID crash?
I think it's going to be slower, but at this point, I don't really know, because we've created such a dislocation here that absolutely nothing would surprise me.
Okay, everything can happen now.
I think that, we have a major credit crisis. That's the problem. So
then why are junk bonds making new highs or retesting the highs again? Now the corporates aren't LQD, but HYG is pushing the high. If there's a credit crisis, why is junk outperforming corporate and
because
LQD?
It's called dumb money.
Okay.
And
isn't the corporate bond market the biggest bubble that we have going on here with what's happening?
It's a huge bubble, and I think that this bond situation is emblematic of a major problem where people are just way too optimistic, and you have late FOMO crowd people coming up and chasing the last dregs of something that's pretty much over. And here's another look at breadth, for example, and this is the biggest breadth non-information I've seen in my 30 years in the markets.
Wow.
And then again, here we are back at this chart, and I think we are very similarly channeling here, retesting this area, doing a throw over, and I think the side effects from this particular setup and the situation are going to be long lasting and probably proceeding into a market that is a downward market for the next several years. That's my view from this. I think personally, I've never seen anything as wacko as what we're dealing with right now.
No one has. Yeah. And people may not know that it's unusual. And that's why I'm glad I had you on to kind of point out different charts that make this seem, show that this is unparalleled, what we have here. I know, maybe 1929. Is that a good analog?
Yeah, I think it's worse than
or 87.
No, much more 1929.
Okay. All right. And what vehicles do you use for taking advantage of the short side? Futures, any
Futures,
ETFs that you,
pretty much futures only. So
okay. All right.
The ES futures, Dow futures, etc.
Okay. All right. Well, I appreciate you being here, Peter. Why don't you show your website or the best place for people to follow this narrative, possibly, want to work with
Well, you can go to find me over here.
Okay.
MCM_CT, and then there's also MCM_.
Your private Twitter feed?
Yeah.
Okay. All right. So
here.
That's how you mainly communicate your ideas nowadays, is through your private Twitter feed?
Yeah.
Okay. Well, you're getting some good response to what you did today. So, I want to thank you, my trading warrior brother. Maybe we should have you back near year end and see how this whole thing played out, huh?
It's going to be a very interesting end of the year for sure.
Yeah.
And I think, we're going to see quite a lot of activity, I think, in the markets. It's going to be pretty.
And I'm told that, Peter, I don't know if you're married or you have kids or you have nephews and nieces, but I'm told that you have to go buy your Christmas gifts now because of the supply chain issues. There won't be much on the shelves. So, and you told me, the last time I talked to you, to go to Target, and if there's some things you need, Americans aren't used to the inconvenience of not being able to get what they want immediately. And I actually had real life experiences with ordering furniture that, they said, okay, yeah, Mr. Pinkert, you might be able to get it by the end of September. And that was a few weeks ago. So it's real what's happening here with, so if there's anything you like at Walmart or Target, don't order it online, just go in and pick it up while it's still there.
Yep.
So I'm looking for your Christmas gift, Peter, and I think I'm going to look for, some type of bear related item for you. Okay. So, all right. So,
okay.
Thanks, partner, for being here and showing your work. Great work, Peter.
Okay. Thank you.
Appreciate it, buddy. All right, everyone. That's Turnaround Tuesday. Hope you enjoyed that interview with Peter the Bear Cambell. And we'll see everyone tomorrow. Good hunting. You could join the team in 14 minutes for the morning edge. All you have to do is sign up. You have time to sign up and catch Blake's bias chart, everything. So take it easy. Don't just count, your VIX and your breath. Count your blessings. And I'll see everyone tomorrow. Thank you, Steve. Adios.